Hi, everyone. I'm Matt Sheridan, Chief Investment Officer at TFL Wealth Partners. Thank you for joining me today. This video kicks off our new quarterly series, Numbers and Narratives. This is a short update to help you make sense of the markets and headlines. Each quarter, we'll handpick a few themes that we believe are most relevant. Look, we know headlines can distort the story, and social media can amplify it. What we're looking to do with this series is keep you focused on what we believe matters most. So let's get started. Just look at some of these headlines that I pulled from the quarter. You may have seen some of them. Tariff risk, markets are riskier than ever, the 60/40 portfolio is no longer going to work. But if you look at actually what happened in the markets, US equities hit 23 separate all time highs in this quarter alone. That ties the most since 1998. That's one out of every 3 trading days the US equity market was hitting an all time high. Clearly, the markets are not riskier than ever. This doesn't mean that you want to avoid the headlines, but context does matter. I'm going to use some of these as jumping off points for some of the visuals I'm going to share. Now let's jump to the markets. They were historically strong in quarter three, almost across all asset classes. This goes squarely against any headline that you'll read that the markets are top heavy or just a handful of stocks are driving returns. That's just not true. What I'd like to do is highlight small cap stocks and municipal bonds, more so because all of their returns really came in the third quarter. Now, small cap stocks relative to their large cap counterparts, generally speaking, tend to be a little bit more reliant on debt financing. So the anticipation in policy shifts with the Federal Reserve and then the follow through, where the Fed in quarter three lowered rates by 0.25%, had a really big impact on the asset class. Now, like small caps, municipal bonds had a really, really tough first half of the year. There were a lot of issuers rushing to the market with fears over tax law changes, where you had a lot of supply. And anytime you have a lot of supply, that's going to put a pressure on prices. There were higher costs because of inflation, which meant that they needed to come with even more supply. And then on top of it, you had a lot of interest rate volatility in the first half of the year. So those 3 things weighed on municipal bonds pretty meaningfully. Now, in the third quarter, 2 of those 3, so certainty over tax policy and interest rates, are at least temporarily off the table. So that really propelled returns for municipal bonds throughout the quarter. But I really just want to highlight on how strong the participation has been in quarter three for most asset classes. What is clear and quite true, this decade has felt volatile because it has been. What we're showing here is the average number of 1% up or down days per decade going back to 1950. And on average, each decade shows about 507 separate occasions with 1% up or down days. So these are the days that are hardest to hold on to your investment strategy. We're already at 445, and we still have 4 years to go. These regimes are impossible to predict, but what history does show is these big up and down days tend to cluster together. We would all prefer calm, but experiencing a few back-to-back years with big daily moves is quite normal and expected. Now, another common headline you'll see is the death of the 60/40 portfolio or some variation of that. And poetically, it's been one of the healthiest years we've seen in quite some time for diversified portfolio returns. And here I'm showing a hypothetical example of just a simple 3 asset portfolio. So US stocks, non-US stocks, and bonds. And I'm not showing the returns, but rather their contribution to returns on the portfolio level. And you can clearly see in 2025 relative to 2021 on the left-hand side, the returns are much more equally distributed. So US equities in 2021 accounted for more than 90% of the total return of a hypothetical 60/40 portfolio, where in 2025, they're less than half. That's exactly what you want to see when you're accumulating wealth. You want the smoothness of returns. And bonds are also contributing again, thanks to higher yields. So coming into the year with 5 to 6% yields on investment grade bonds, having returns on the yearly basis of roughly about 6% makes total sense. And it's exactly what you would expect because higher starting yields matter so much on total bond returns. This is one of the neat benefits that we got from the Great Reset in 2022 with bond yields rising. You'll also often hear that markets are riskier now because companies are really so big. And look, concentration is real, But like anything, context matters. And these are usually directed right at US companies. But you can clearly see in this visual that concentration is a global phenomenon. All the way on the left hand side, we're showing the average of the top 10 largest and the top 25 largest names in equity indices on average for the 10 largest countries in the world. And on average, on that left-hand side in that dark green bar, the average in the top 10% is roughly 48%. This dark green bar right to the right of it is the US market is 39%. So it's actually lower in the US than it is on average outside of the US. So most headlines will not share that. There are also now 11 separate companies worldwide worth more than 1 trillion in market value. 9 of those are in the US. So you're invariably going to get reports that compare what we're experiencing today to the dot-com era, but that really misses some of the scale and diversification and nuance to that argument. It's true that the top 10 names in the US market account for 39% of the total value of the index. But if you look at their contribution to earnings on the index level, it's 33%. So not that far away. Also, their profit margins are 2 times higher than the other 490 companies. So there's reasons behind this. It doesn't just happen because. And most importantly, many of these companies are no longer single product companies. So look at the Mag 7 as an example. They get a lot of headlines. Since their inceptions, those 7 companies have acquired over 850 different businesses. So you have a company like Microsoft that does hardware, software, gaming, cloud computing, AI infrastructure, even cybersecurity. Alphabet, which is the parent company to Google, does search, YouTube, autonomous driving, wearables, and cloud computing. Even if you were to look at a defensive company like Walmart, they generate $693 billion in revenue. So if you were to pluck Walmart out of the US market and treat it as a country, it would rank in the world's top 25 largest economies. There are certainly pockets of speculation. There always have been and there always will be, but there are real cash flows behind some of the scale that we're seeing in these global companies. These are just a few examples of headlines that we believe do not tell the full story. So look, not every period will look this steady. And when conditions change, we will try our best to be clear about what we think it means. But for now, staying diversified, sticking to your long-term plan to us still makes the most sense. We look forward to sharing more as we continue this series. We appreciate your time.